For 2 glorious years, Florida was the ultimate American dream. With an influx of over 700,000 new residents, the market went vertical. Bidding wars became the norm, and home prices in major hubs like Miami, Tampa, and Orlando skyrocketed by a staggering 45% to 60%. But fast forward to today, and that soaring market has hit a wall. Experts are now sounding the alarm, warning that Florida could be facing the biggest real estate collapse in U.S. history. The signs are undeniable. Insurance companies are abandoning the state, premiums have been aggressively hiked by up to 500%, and homes that sold for top dollar in 2022 are now sitting unsold at a loss. This dramatic U-turn has already driven 250,000 people out in a matter of months. The true cost of this sudden retreat is only beginning to reveal itself. How did the nation's most desirable market become an epicenter of financial risk? And exactly how catastrophic will the fallout be? The frenzy began in 2020. Between then and 2022, Florida's population growth outpaced every other state. People were packing up U-Hauls from the Northeast and Midwest, flocking to the Sunshine State. This included remote workers escaping lockdowns, retirees chasing warm weather, and families seeking lower taxes. Florida became the #1 destination for one-way moves for 2 consecutive years. The migration was immense, school districts scrambled to hire teachers, new construction sold out instantly, and rental vacancies simply disappeared. Buyers from California, New York, and Illinois were offering cash and waiving appraisals just to secure a property. This endless demand pushed prices ever higher. It quickly became a speculative mindset. Listings that once lasted weeks were gone in hours. In some areas, more than half of all sales were closed without financing as buyers raced the clock against rising prices. Stories of instant appreciation fueled the fear of missing out, drowning out any whispers of a bubble. Investors armed with cash drove nearly 40% of sales in Tampa in 2022. Everyone believed Florida was immune, convinced that the only direction for their fortunes was up. But lurking just beneath the surface of the boom were immense, growing risks. Insurance companies were the first to blink, starting to pull out of the state in massive waves. In less than 2 years, 6 major carriers withdrew or severely limited their business. This exodus triggered a chain reaction, with notices of policy cancellations hitting mailboxes overnight. Carriers cited 3 main culprits: catastrophic hurricane losses, runaway legal costs from litigation, and reinsurance bills that had doubled in 3 years. As private options vanished, the burden was transferred to Citizens Property Insurance, the state's last resort insurer. Citizens enrollment has ballooned from under 500,000 policies in 2019 to over 1.3 million by mid-2023. In high-risk areas, Citizens now holds more than 40% of all residential policies. The math for insurers has simply stopped working. Global reinsurers, who stabilize the entire market, have raised their prices by 30% to 50% or entirely refused to renew contracts. Florida carriers now spend more than half of every premium dollar on reinsurance, double the national average. Actuarial models predict losses that are now uninsurable at an affordable price. The reliance on Citizens is itself a major vulnerability. It was designed as a safety net, not the primary insurer for a state of 22 million. A single, devastating storm could wipe out its reserves, potentially leading to emergency assessments and higher taxes for every Florida policyholder to cover the shortfall. The consensus among global insurers is clear: Florida's risk is unmanageable. The crisis is no longer theoretical, it's a daily financial battle for millions. In Naples, a retired couple watched their annual premium jump from $3,000 to $14,600 in just 3 years. For a median-priced home in Tampa, insurance now costs between $4,200 and $6,500 annually, up to 5 times the national average. Property taxes have climbed by 25% in many counties, and HOA fees have soared by 30% or more. For retirees on fixed incomes, this math is unforgiving. The only options left are draining savings, cutting essentials, or selling the home they thought was their last. Agents are fielding calls from longtime residents desperate for relief or tearfully planning their exit from the state. The promise of sunshine and peace of mind is colliding with a financial reality no one can. The core of the crisis lies in the escalating physical threat. Hurricane Ian in 2022 resulted in $113 billion in losses, making it the costliest hurricane in the state's history. Less than a year later, Hurricane Idalia added billions more to the mounting catastrophe bill. NOAA projections show Florida's future is fundamentally defined by rising water. Sea levels have already climbed 7 inches since 1950, and that rise could reach another 18 inches by 2050. Experts estimate that $1.2 trillion worth of coastal property is at risk from chronic flooding within the next 25 years. Catastrophe models that once treated a Category 4 storm as rare now forecast billion-dollar storms every few years. The physical threat is pushing parts of Florida toward becoming uninsurable. The market is showing unmistakable signs of failure. Inventory has surged by 85% compared to last year in Miami, Tampa, and Orlando. The average listing is now sitting on the market for 90 to 120 days, up from just 20 days during the boom. Median sale prices have dropped 8% to 15% from their peak, with coastal sellers slashing prices by $100,000 or more. Sellers are cutting prices repeatedly, often just to get a single showing. Cash buyers, the engine of the boom, are now pulling back, with sales dropping more than 20% year over year. Distressed sales are piling up as investors and owners on variable-rate mortgages can no longer afford the skyrocketing carrying costs. The market is effectively frozen, as the flood of buyers has turned into a mere trickle. The result is a historic reversal of migration. In the first half of 2024, more people left Florida than arrived. That's a net loss of 275,000 people. U-Haul now reports more trucks leaving the state than coming in, a mirror image of the frenzy 2 years ago. Families who moved for a better life are now leaving because of costs they cannot manage. This exodus impacts every part of the economy. School districts in Miami-Dade report falling enrollments, and small businesses are seeing fewer new faces. Every family that leaves contributes to the surge in inventory, further diminishing the hope of a quick sale for those left behind. The engine that powered the boom has stalled, replaced by a profound uncertainty. The pain is spreading. Construction sites across the state are now silent. Building permits in Cape Coral are down by half. Developers are canceling projects for entire subdivisions as buyers disappear. Florida now accounts for a quarter of all new project cancellations in the country. Local governments are feeling the squeeze on tax revenue. Cape Coral is facing a $38 million shortfall due to falling home values. At least 12 counties are forecasting property tax declines of 3% to 9%. With over 10,000 construction jobs lost since late 2024, every canceled project and budget cut makes recovery harder. Bankers are now focused on damage control. Regional financial institutions are flagging their exposure to Florida real estate as their top concern for 2025. Internal bank estimates warn that if prices drop another 20% to 30%, a scenario many analysts see as likely, over $1 trillion in property value could vanish. The Federal Reserve has flagged more than 50 Florida-based banks for heightened monitoring. Given that Florida holds nearly 12% of all outstanding U.S. residential mortgages, a correction of 30% to 40% could lead to a $1.4 trillion loss, sending a shockwave through the entire financial system. Loan performance in Florida is already deteriorating faster than anywhere else. Government mortgage giants Fannie Mae and Freddie Mac have begun limiting their exposure, refusing to purchase or refinance mortgages on properties without full wind and flood coverage. Lenders face a difficult choice: call in loans or risk holding assets that may soon be worth a fraction of their value. As one bank risk officer put it, "We're not just worried about Florida anymore. If this spreads, it's a national problem." The collapse is not uniform. Coastal hotspots like Panama City Beach are drowning in empty condos, with Airbnb listings outnumbering bookings 3 to 1. The Keys are facing uninsurable homes and median sale prices down more than 15%. Cape Coral, hit hard by Hurricane Ian, has seen its foreclosure rate double as owners were forced onto costly policies. Even the inland villages, a massive retirement community, are now seeing a correction, with double the number of homes for sale as insurance costs hit fixed incomes. The pain is sharpest where climate risk and insurance costs intersect, but nowhere is truly untouched. The map of Florida's real estate crisis is a patchwork of distress, all pointing to a market where the old rules simply do not apply. Florida's net migration flipped from a record 700,000 person inflow to a 275,000 person net loss. This, combined with the 85% housing inventory surge and 500% insurance premium hikes, has exposed the market's severe fragility. Experts warn of a further 20% to 30% decline over the next decade. The collapse was driven by three measurable factors: unchecked population growth, rampant speculative investment, and mounting climate threats. This crisis is a turning point that will reshape the national conversation about where Americans choose to live, invest, and retire.